Have you ever wondered how the biggest company on the internet lost to a tiny startup operating out of a garage? In the late 1990s, Yahoo wasn't just a website, it was the internet. If you wanted to check your email, read the news, follow sports, track the stock market, or search the web, chances were you started with Yahoo at its peak. It attracted hundreds of millions of users every month, employed thousands of people, and was worth over $125 billion. Meanwhile, Google was just another search engine with a strange name that most people had never heard of. Less than 20 years later, Google had become one of the most valuable companies in history, while Yahoo had been sold for a fraction of its former value. So what happened? How did the king of the internet lose everything? The answer wasn't one bad decision. It was years of missed opportunities, strategic mistakes, and a complete misunderstanding of what the future of the internet would become. Yahoo was founded in 1994 by Stanford graduate students Jerry Yang and David Filo. At a time when the internet was still confusing and chaotic, Yahoo solved a simple problem, helping people find websites. Instead of relying on algorithms, Yahoo organized the web into categories created by human editors. Users could browse through topics like news, sports, business, entertainment, or technology to discover websites. It was essentially a digital phone book for the internet. As the web exploded in popularity, Yahoo grew with it. The company quickly expanded beyond search. It launched Yahoo Mail, Yahoo Finance, Yahoo News, Yahoo Sports, Yahoo Messenger, and dozens of other services for millions of people. Yahoo became the homepage they visited every single day. If you were online in the late 1990s, Yahoo wasn't just part of the internet, it was the internet. Investors loved the company. During the dot-com boom, Yahoo's stock price skyrocketed. By early 2000, its market value exceeded $125 billion, making it one of the most powerful technology companies in the world. But while Yahoo was celebrating its dominance, two graduate students at Stanford were quietly building something very different. Larry Page and Sergey Brin believed the internet didn't need a better portal. It needed a better search engine at the time. Most search engines ranked websites based on how many times keywords appeared on a page. The results were often cluttered, inaccurate, and easy to manipulate. Google introduced PageRank, an algorithm that evaluated the importance of websites based on the links pointing to them. Instead of simply matching keywords, Google tried to understand which pages were actually useful. The difference was obvious. Searches became faster, results became more accurate, and unlike Yahoo's crowded homepage, filled with advertisements, news, weather, and dozens of links, Google's homepage contained almost nothing except a logo and a search box. It looked unfinished. Many people thought it was too simple, but users loved it. Ironically, Yahoo itself helped Google become successful. In 2000, Yahoo decided not to invest heavily in improving its own search technology. Instead, it outsourced search results to Google. Every time someone searched on Yahoo and clicked a result, they were actually experiencing Google as technology. Millions of users unknowingly discovered that Google as search engine worked better. Yahoo had introduced the world to its biggest future competitor. Instead of asking why users preferred Google as search, Yahoo focused on keeping people inside its own ecosystem. That decision revealed a fundamental misunderstanding. Yahoo believed it was a media company. Google believed it was an engineering company. Yahoo wanted users to stay on its homepage for as long as possible so they would see more advertisements. Google wanted users to find answers as quickly as possible and come back again tomorrow. Those philosophies shaped every decision both companies made over the next decade. Perhaps the most famous mistake came in 2002. Yahoo had the opportunity to acquire Google. Google reportedly wanted around $3 billion. Yahoo thought the price was far too high. The deal never happened. At the time, that decision seemed perfectly reasonable. Google was still relatively small, and few people imagined what it would eventually become. Today, Google is worth trillions of dollars. That rejected acquisition has become one of the most expensive missed opportunities in business history. But refusing to buy Google wasn't Yahoo's only problem. The company struggled with constant changes in leadership and direction. Instead of building a clear long-term strategy, Yahoo kept chasing the next big trend. It spent billions acquiring companies such as GeoCities, Broadcast.com, Flickr, and Tumblr. Many of these products had enormous potential, yet Yahoo often failed to integrate them properly or continue investing in them. Talented employees left. Innovation slowed, competitors moved faster. While Yahoo was trying to become everything for everyone, Google stayed remarkably focused. Google perfected search. Then it built AdWords, creating one of the most profitable advertising systems ever invented. Next came Gmail, and Google Maps, then Google Earth, then Android, then Chrome, then YouTube. Each successful product strengthened the entire Google ecosystem. Yahoo launched products too, but many lacked the same level of technical innovation or long-term commitment. By the late 2000s, the gap had become impossible to ignore. Google dominated internet search. Its advertising business generated enormous profits. Its software reached billions of users around the world. Yahoo, meanwhile, was losing market share almost everywhere. The company cycled through CEO after CEO, each promising a turnaround that never fully arrived. Even Marissa Mayer, a respected former Google executive hired in 2012, couldn't reverse years of strategic mistakes. By then, the market had already moved on. In 2016, Yahoo agreed to sell its core internet business to Verizon for roughly $4.8 billion. For a company once valued at over $125 billion, it was a dramatic fall. The brand that had once defined the internet had become a cautionary tale. Looking back, Yahoo didn't fail because Google was lucky. It failed because it misunderstood what users truly valued. Yahoo believed the internet was about keeping people on a web page. Google focused on building better technology for tomorrow. In business, success can create confidence. Too much confidence can create complacency. And complacency is often the beginning of decline. Yahoo had the users. Yahoo had the money. Yahoo had the brand. What it didn't have was the willingness to reinvent itself before someone else did. In the end, Google didn't simply beat Yahoo. It built the future while Yahoo tried to protect the past. And in the technology industry, history has shown that the future almost always wins.